Okay, so we can begin on this question. So we're going to continue on the question we did last week, which is, I can't remember the name. It is stat letter, it is FAC4861, stat letter 104, 2020. It is test 3 of 2019. So we already got to a certain point. So we'll continue from there. I'm just going to browse over the scenario again, just to familiarize ourselves with the scenario, and then we're going to continue straight into answering the question. As I go through answering the question, we will bring some important important principles and rules relating to impairment. So I'm just going to switch my screen. Okay, so here we have as question 1 on page 51 of the stat letter. So the South African Global is a manufacturing company that specializes in the development and manufacture of technologically advanced security systems. The company has a 28 February financial year end and is listed on the Johannesburg Stock Exchange. So the security camera plant. So they say on 1 March 2015, African acquired the security camera manufacturing business from Busasu Ltd, an independent third party, and recognized the acquisition thereof by processing the following journal entry on the same day. So there you can see there is the manufacturing building, we have equipment, we have security, camera, patent, we have inventory, we have provision to dismantle the manufacturing building, we have goodwill, and then we have bank. So as you can see, can we just read a bit further? Then they say, you may assume that this journal entry is correct and that the underlying assets and liabilities of the security manufacturing business cannot generate cash flows independently from each other. So remember, we discussed this and we said that when you do impairment, you want to impair an individual asset. However, if an individual asset does not generate cash flows independently, you will have to impair this individual asset by determining by including that asset in a cash generating unit. So just keep that in mind. So now they told us that none of these assets, underlying assets, can generate cash flows independently. So if there is an indication of impairment, we will have to impair the individual assets by using a cash generating unit. A cash generating unit, that is the smallest group of assets that can generate cash flows independently. Remember, we said that when you look at the cash generating unit, you must include all assets and all liabilities that relate to that unit. However, and you will compare that carrying amount to the recoverable amount of that cash generating unit. And if the recoverable amount is less than the carrying amount, we will have an impairment. That impairment loss will have to be allocated to the underlying assets. But remember, it can only be allocated to the underlying assets that falls within the scope of IAS 36. So we said it would be PPE, which is the manufacturing building and the equipment. It would be intangible assets, which would be the camera patent, as well as goodwill. Remember, inventory will not be allocated, impairment will not be allocated against inventory because IAS 36 does not apply to inventory. Provision to dismantle is a liability, and as a result, there's no impairment. So just take note of that. Then they say on 1 March 2015, the following was estimated. Manufacturing building, they have a useful life, 20 years, equipment 20 years, and a security camera patent, it is indefinite. If you remember, we said that in order to perform an impairment test, there must be an indication of impairment. Only once there is an indication of impairment will you perform an impairment test. The impairment test is comparing the carrying amount of the asset or the carrying amount of a cash generating unit to its recoverable amount. An asset or a cash generating unit's recoverable amount is the higher of fair value less cost of disposal and value in use. Now, the important part there was that you only perform an impairment test when there is an indication of impairment. But remember, there are two exceptions. If a cash generating unit includes an intangible asset with an indefinite useful life, you will have to test that cash generating unit for impairment annually. And similarly, if a cash generating unit has goodwill, you have to test the cash generating unit annually. Because remember, goodwill and an intangible asset with an indefinite useful life needs to be tested for impairment annually. So you don't have to wait for an indication of impairment. Okay, so then they have equipment has a residual value of 200,000. So they say on 28 February 2019, headline news implied Africans' involvement in fraudulent activities when an irregular government contract was granted to the company for the supply of security cameras. Due to the reputational damage that it has caused, it is expected that African security camera sales will be adversely affected. So there you can see it is there's an adverse event that took place. So that is an indication of impairment. Okay, the sales will be impacted. So that is an indication of impairment. But even if there was no such indication of impairment, we would still have to test for impairment because the cash generating unit, which is the smallest group of assets that generates cash flows independently, has goodwill and an intangible asset with an indefinite useful life. According to African's procurement policy, all the contracts have to be authorized by the directors of the company. To date, the directors of the company have indicated that they do not intend to investigate the matter in order to identify the person responsible for obtaining the irregular contract. On 28 February 2019, so now we know this was acquired 1 March 2015, but we are in the 2019 financial year. So they're saying on 28 February 2019, the fair value less cost of disposal of the security camera manufacturing business, that is the cash generating unit, which constitutes the amount that an independent third party will pay to acquire all the assets and the associated liabilities of the business that their purchase is required to take over, amounted to 21 million. On this date, the value in use after deducting the carrying amount of the associated liabilities were determined at 21.5 million. Okay, so that's important to take note. So we have the recoverable amount. The recoverable amount is the higher of value in use and fair value less cost of disposal. The fair value less, so we know the value in use is the higher amount, so that is our recoverable amount. What do we need? We need to determine the carrying amount so that we can see whether there is any impairment. If the carrying amount exceeds the recoverable amount, if the carrying amount exceeds 21.5 million, then we would have to impair, and that impairment will have to be allocated against goodwill first, and then any remaining impairment will have to be allocated on a pro rata basis against the remaining assets that fall within the scope of IAS 36. Okay, so just take note of that. So here we give information. We have carrying amounts, okay, and you can see manufacturing building and equipment we have to sort out. They gave us the security, they gave us the inventory, the provision to dismantle, we'll have to work that out, and they gave us deferred tax. What is missing over here is goodwill. We have to include goodwill as well. Okay. What's important to take note, we're going to need these numbers over here. Okay, so you can see the fair value less cost of disposal. We're going to use that once we do the impairment calculation. Okay, so they're giving us some notes over here. The accounting policies. Okay, they gave us accounting policies. They said the manufacturing, building, and equipment on 28 February 2019, there was no indication that the manufacturing building and equipment individually were impaired. The residual value of the equipment did, however, change to 350 on this date. Okay, so there's a change in estimate. There's an inventory on 28 February included in the inventory balance of 400,000 worth of security cameras that have outdated systems and could only be sold as spare parts at 25% below their cost price. Okay, so we'll have to have a look at that. I'm not going to read further because further relates to a separate question. So now let's go work out the carrying amount of so now we can go work out the carrying amount. Okay. Okay, you should see the, what should you see? You should be able to see the workbook, Google Docs. So here we have the manufacturing building, we have the equipment, we have the security camera, we have inventory, we have goodwill, we have the provision, and we have deferred tax, okay? And then we have our recoverable amount. Our recoverable amount is the higher of the two, both were given, so that is fine, okay? So now we're gonna have to work out So now we have to work out the remaining items. The deferred tax liability was given to us. So if we go to the deferred tax liability, it was given to us as 838,263. So I'm just going to plug it in. Negative as a liability, 838,263. Okay, so that was given. Okay, so the rest we're going to have to work out. So let's work it out. Okay, the security camera was also given. There was no additional information relating to the security camera, so we can use it at 2.5 million. Okay, so we can leave it at 2.5 million. So what we're going to have to do, we have to work out the manufacturing building, we have to work out the equipment. So now I'm going to put in here my workings. So working one, the building is PPE. They use the cost model, and depreciation is using the straight line method. So to work out the carrying amount, we need to work out, we're going to say cost price minus accumulated depreciation gives me a carrying amount. Okay, so we know what is the cost price, but we don't know what is the carrying amount. So remember, we need carrying amount as at 28 February 2019. So here we're going to have costs, we're going to have accumulated depreciation, and that's going to give us carrying amount at 28 Feb 2019. Okay, so that's what we want. Cost price was given to us. Cost price was given to us. Cost price of the manufacturing building was given to us as, let me just quickly see something. Okay, so only the equipment changed, manufacturing didn't change. Cool. Okay, so what was the cost price? So the cost price of the building was 14 million. Oh, sorry. 14 million. Okay, now we need the accumulated depreciation. So the way we can work out the accumulated depreciation, because we're using the cost model and the straight line method, we can work out accumulated depreciation. So remember, depreciation is going to be cost price less residual value and that's going to give us our depreciable amount. I'm just doing the long way, so you can just see all the principles being applied, so you can see where exactly we're getting the numbers from. You don't have to go through all of these unnecessary steps, okay? So there's no residual value, you don't have to put in anything. But I just want to show you the full picture. This is depreciable amount. So the cost price, like we said, is 14 million. Okay. The residual value, there was no residual value for given for the building. So therefore we say 14 million minus residual value, which gives us, so our depreciable amount equals the residual value. I mean, the equals the cost. So now our useful life is 20 years. So annual depreciation is whatever it is. So it is 14 million divided by 20. So annual depreciation is so annual depreciation is 700,000. Now, from 1 March 2015 until 28 February 2019, so 1 March 2015, 28 February 2016, 17, 18, 19 is 4 years. Okay, so number of years. So it was full years, so we can just 4. So therefore, accumulated depreciation. So therefore, accumulated depreciation is, so accumulated depreciation at Feb 19 would be whatever that is. So 700,000 multiplied by 4 years which is 2.8 million. If you guys did the answers already and you get different, just let me know, okay? So here we have accumulated depreciation. I'll make it negative 2.8 million. So therefore, that will give us, so our carrying amount at 28 February 2019 is 11.2 million. Okay, so if I go over here, manufacturing building equals 11.2 million. I'll tell them, where did I get it from? I got it from working 1. Now I must do the equipment. Okay, so now we're going to have to do the equipment. The equipment is a little bit different because the residual value changed at 31. The residual value changed at 28 February 2019. So in the current year, the residual value changed. So we'll first have to work out the carrying amount at the beginning of the current year. We first have to work out the carrying amount at the beginning of the current year in order to get the correct depreciation for 2019. So just take note of that. So I'll explain it now to you. This is just applying change in estimates that you have done at the beginning of the year. So for working 2, we're going to do the same thing. So for working 2, we're going to do the same thing. Only difference, obviously, the cost price is different. The equipment's cost price is 8.2 million. Okay, this is obviously going to change. Okay, so that will obviously change. So now what we're going to do, we're going to have to work out the accumulated depreciation. Okay, so the accumulated depreciation, we follow the same approach. We'll follow the same approach. Okay, so remember, it is 8.2, cost price is 8.2. The residual value for the equipment is not 0, it is 200,000. So therefore, costs minus the residual value give you the depreciable amount. The useful life was also 20 years. So we say 20, so annual depreciation is 400,000. But now the difference over here is as follows. We can't take depreciation up until, we can't multiply by 4 years because there has been a change in estimate in the current year. So we can only go up until 28 February 2018. So we had this in 1 March 2015, it will be 28 February 2016, 2017, 2018. So that is 3 years. Okay, so that is 3 years. So accumulated depreciation as at 28 February 2018 is 1.2. Okay. Then we have to work out depreciation in the current year, taking into account the change in estimate. So when there's a change in estimate, the way you work out depreciation is by saying the carrying amount. You must use the carrying amount at the beginning of the current year, or at the beginning of the year that the change in estimate took place. The change in estimate took place in the 2019 financial year. So therefore, we need the carrying amount at the beginning of the 2019 financial year in order to work out the correct depreciation. Okay, so now we're going to have to work out the correct depreciation. Depreciation in current year will follow the similar approach. Now the cost price is no longer 8.2. We need to use a carrying amount. We need to use the carrying amount. So this needs to be carrying amount at the beginning of the year. This is rules that this is the principle that you have learned in IAS 8, changing estimates and errors and all of those type of stuff. We did it for test 1. Okay, so I'm just going to run through this. So the change in estimate happened in the current year. Whenever there's a change in estimate that happens in the year, you must apply it to the year. You must apply it from the year it took place and going forward. You don't go back in time. Okay, so the change in estimate happens in 2019. So you implement the change in 2019 and going forward. So in order to do that, we have to start off with a carrying amount at the beginning of 2019 financial year. We must start with a carrying amount at the beginning of the year in which the change in estimate takes place. So because the change in estimate took place in the 2019 financial year, we need the carrying amount at the beginning of the 2019 financial year, which is our current year. Okay, so the carrying amount is going to be costs minus accumulated depreciation. We know cost price is 8.2. And what we also know is that accumulated depreciation at the 1st of March 2018 is 1.2. So therefore, our carrying amount at the beginning of the current year is 7 million rand. Now we're going to say, now we must take in the new residual value. What is the change in estimate? It was the residual value, 350,000. So as you can see, our depreciable amount changes. But now we don't use the useful life. We have to use the remaining useful life. Remaining useful life. Okay, so now we use the remaining useful life. The total useful life is 20 years. 3 years have passed. So what is the remaining useful life? 17 years. So the way you just do it, you just say total useful life minus the number of years that have passed, which is 3. So now it is 17. The remaining useful life is 17 years. So therefore, annual depreciation going forward is 391. So accumulated depreciation. So accumulated depreciation at Feb 2019 is going to be depreciation accumulated depreciation up until Feb 18 plus the depreciation in the current year. Okay, so just take note of that. So now we can take that above. So this is C55. So when I come to working 2, I'm going to say equals C55. Okay, so I'm just going to change this formula. So cost price minus accumulated depreciation. I'm going to change it here above as well to make it make more sense. So I'm going to leave that positive. But we're going to say costs minus accumulated depreciation. Okay, I think most of us understand it better that way. Okay, so the final answer is 6.6. If you have something different and you did it, you can just let me know. Okay, so this is C37.
I have a question.
Come there now. Yes.
So if the change happened at the end of the year, on the 28th of February.
Yeah.
So don't you apply it in the 2020 year going forward?
No. So you have they made the change in the 2019 financial year. So the accounting standard says you apply it in the current year and years going forward. So they are still doing their financial statements, right? They know they are changing it. They are changing it in the 2019 financial year. So you apply it in the year it has taken place. A very good question, but yes, you must apply it from the year in which the change took place, no matter when you made it, whether you made the change. Because remember, if you in terms of IAS 16, they'll tell you annually you'll have to review and assess your estimates. Your estimate is your useful life and it is your residual value. So before you do any depreciation calculation and so forth, you need to do an assessment. So after you have done your assessment, you need to apply any changes in the current year. Okay. So that's a good question. Okay. You apply it in the current year. Your change in estimates will hardly be changed during the year unless your annual assessment happens during the year. Okay, so that is working as equipment. So working 2. So what you can see is that this is an impairment calculation, right? But how do you see how they're bringing in PPE quite extensively? You're doing quite a bit of PPE calculations to calculate the carrying amount of PPE. Because remember, ultimately, that is the whole point of IAS 16, to get the correct carrying amount on the statement of financial position for property, plant, and equipment. Okay, so they're basically testing PPE quite extensively over here. Might be simple PPE related things, but they're still testing PPE quite extensively. Now we're going to do working 2, working 3, which is inventory. As you can see, they're bringing in inventory. When did you cover inventory? For test 1. If you break CTA into quarters, the first quarter, which is for test 1, you covered inventory and you covered change in estimates. So change in estimates will definitely come through over here, because change in estimates it affects PPE quite strongly. Because like I said, in IAS 16, the significant estimates is your useful life and is your residual value. So over there, they'll have to assess it every single year. For test 1, you covered IAS 8, which to deal with the change in accounting policy. A depreciation method, I think a depreciation method is considered a change in accounting policy. I think, I'm not sure actually. Yeah, I'm gonna actually check that. So you see that topic falls nicely with PPE. Now they're bringing in inventory as well because you're dealing with a cash generating unit. In many cases, the cash generating unit do have inventory. Okay, so that's why they're bringing that in. So you need to know your principles of inventory for what you call it, for this as well. So now inventory, they gave us the cost price. Okay, so they gave us the cost price. But remember, inventory, inventory must be recognized at the lower of cost and net realizable value. So inventory, I'm just writing this here for our purposes. You don't have to put this in the exam. Inventory is recognized on the SFP, Statement of Financial Position, at the lower of cost and net realizable value. Cost was given. Okay, so cost was given. What was cost was given? What was the 3.2? Let me just check. Cost was given to us as 3.2 million. 3.2 million, and that was given. Okay. Now we need to work out NRV. Okay, so now we need to work out NRV. So what is NRV? Okay, so this would be inventory write down. Okay. Okay, so NRV, we have to work out what is NRV. They told us, so we have a cost price of 3.2, right? So we have a cost of 3.2, but of the costs, so I'm just going to say here, included in the cost, okay? If we go to note number 3, just scroll down, go to note number 3, they say on 28 February 2019, they say included in the inventory balance of 400,000 Rand worth of security cameras that have outdated systems and could only be sold as spare parts at 25% below their cost price. Okay, so included in the cost is normal security systems, if I can just call it that, and then outdated security systems. Okay, so remember it is 3.2, total cost is 3.2, 1, 2, 3, but included in the 3.2 is 400,000 Rands worth of inventory that is outdated. So we take that out so we understand that 2.8 is the normal security system, okay, non-outdated. Then the security system, the outdated security system, the cost price is 400,000, but because it's outdated, it can only be sold for 25. It can be sold for 25% below the cost price. So basically, it can be sold for 75% of the cost price. So therefore, cost price is 400, and it can be sold for 25% below the cost price, which ultimately means, or put another way, it means it can be sold for 75% of the cost price. So multiplied by 75%. So therefore, NRV so this here is NRV, which is equal to the sum. So NRV is 3.1. So remember, inventory must be recognized at the lower of cost and NRV. Which one is lower? NRV is lower, so therefore there will be a write down. Okay, so NRV write down. Remember, anything that goes against inventory goes to cost of sales. So what you must know, we don't need the write down. I'm just making the picture full. Okay, I'm just giving you a full picture. So the write down would be, you need to reduce cost to N or V. So it's the difference between the two. So the write down is 100,000. But what are we interested in? We interested in the correct carrying amount. The correct carrying amount that must be recognized on the statement of financial position for inventory is the lower of cost and N or V. Which one is lower, N or V? So we're going to choose that one, which is C59. So C59. Okay. And we're going to say they can go look at working 3. Okay. Now the only thing that is left is the provision. The only thing that is left is the provision. Okay. So far we're above recoverable amount. So when carrying amount exceeds recoverable amount, there will be an impairment. However, we'll have to have a look what is the provision, because the provision will reduce this carrying amount. So we'll see whether it will reduce below 21.5. If carrying amount is less than the recoverable amount, no impairment loss, we do nothing. But if the carrying amount exceeds the recoverable amount, we have to reduce the carrying amount to its recoverable amount, and that reduction, that difference is your impairment loss. Okay, so just take note of that. So now we can go work out working 4. So now we can do working 4. So what do they want? They never gave us the provision. They never gave us the, what is this now? Where is that thing? Okay, so they gave, they never, the provision for dismantle is a question mark. So that means we have to calculate it. So on 1 March 2015, it was given to us as 150,000 Rand. Okay, so it was given to us as 150,000 Rand. So we need the present value. We need a value. Okay, so we need a value at 31 March. No, what do we need? So we have the value at 1. We have the value at 1 February, at 1 March 2015. We need to get the value on 1 February, on 28 February 2019. So we want the future value. Okay, so we want the future value. We have the amount on 1 March 2015. We need the amount on 28 February 2019. So we're moving forward. That means we need the future value. If you're moving backwards, then you need the present value. Okay, so we have 2015, we want 2019, therefore we're moving forward. So that means we must get the future value. So to get the future value, we need the present value, we need PMT, we need N, and we need I. Now, I is that pre-tax rate that they gave us. So if you go to your additional notes somewhere right at the bottom, so I think right at the end of the scenario, just go to your scenario right at the end. There's additional information. They say you may assume that an annual after-tax discount rate of 6.48 is applicable since the acquisition date of the security camera manufacturing business. So they gave us a discount rate, and they gave us an after-tax discount rate. Remember, for accounting purposes, we are always interested in a before-tax discount rate, or the way accounting puts it, a pre-tax discount rate. So what we're going to have to do, we were given 6.48%, but that represents 72%, an after-tax rate. So to get to 100%, you just divide by 0.72. Okay, so the tax rate, the pre-tax rate is 9%. Okay. The N is where we want to move to. Okay, so we are at the beginning of the year. We are at 1 March 2019. We want to get to 28 February 2019. We had 1 March 2015. We want to get to 28 February 2019. So how many compounding periods are we moving forward? So the way you get the compounding periods, you will say number of years multiplied by the number of compounding periods per year. Now, there's only one compounding period per year, so we're just interested in the number of years. So from 1 March 2015 until 28 February 2019, we already did that calculation above. It is 4 years. Payment, there's no payment is your fixed regular payment, right? Your fixed regular payment. There's no fixed regular payment when it comes to this, so that is 0. The present value is 150. That is what is given. Remember, we make present value negative. So now we can work out future value. So the future value equals future value. I just need to see how Google puts in the numbers, right? Okay, so it is right, number of periods, payment amount, present value. Okay, so they want rate, then they want number of periods, then they want payment, then they want present value, then they want whether cash flows happen at the beginning or the end of the year. They never mention that it happens at the beginning of the year. So therefore you assume it's the end. Generally in Excel and in Google Docs, cash flows at the end is 0, cash flows at the beginning is 1. On your financial calculator, you set your financial calculator beginning of period or end of period. On your financial calculator on the display screen, if you don't see BGN or BEG, then that means it's not in the beginning, it's at the end. You want the default setting for the financial calculator is cash flows at the end of the period, so you see nothing. And that's what you want your calculator to be in. You only change your calculator to be BGN or BEG at the beginning of the period if the question tells you that cash flows happen at the beginning of the period. Okay, so there we go. So that means our provision for dismantling is 211,000 Rand. So this is C67. So when I go over here, it's a liability, so I'll make a negative C67, and there we go. Okay, so working for. So as you can see, what do you notice? Our carrying amount of the cash generating unit exceeds the cash generating unit's recoverable amount. Because of that, we need to we'll have an impairment loss. Okay, so we'll have an impairment loss. Okay, so we have an impairment loss for the difference. Carrying amount less recoverable amount. When you put through that impairment loss, what do you know is that when you put through that impairment loss, then your carrying amount of the CGU will equal the recoverable amount, and that is what you want. Okay. Now we have the impairment loss. The next step is to allocate the impairment loss to the assets that falls within the scope of IAS 36. Remember the assets that fall in the scope of IAS 36. So firstly, identify all your assets. These are all our assets. Those are all our assets. The other two things below are liabilities. So only assets can be impaired. So we identified our assets. Now we need to ask ourselves, which of these assets fall within the scope of IAS 36? We said all of them besides inventory. So you're going to allocate it to all the assets that fall within the scope of IAS 36. Now that you know which assets fall within the scope of IAS 36, now we'll do the allocation. The allocation works as follows. Step number 1, you first allocate the impairment as far as possible to goodwill. Until goodwill is fully written off, then whatever is remaining, you will have to allocate elsewhere. Okay, you allocate to the remaining assets on a pro rata basis. So basically what we will do, I just actually take this, just change this quickly. Okay, so now we're going to say allocated against goodwill. So you want to allocate as far as possible. You must have a look. Does goodwill, if goodwill exceeds 2.2 million, you must limit it to 2.2 million. But as you can see, goodwill is 1.35. So therefore, we allocate the full amount. We allocate goodwill as far as possible. So what do you see? We're going to allocate first against goodwill and then remaining assets that fall within the scope of IAS 36. So how much we can allocate to goodwill? Because goodwill amounts to 1.35 and in the impairment loss is 2.2, we can allocate the full amount against goodwill. So that means what is allocated against the remaining assets is the difference. 2.2 minus 1350. So what we allocate against the remaining assets is only 858. Okay, so now we must do the allocation. Okay, so now we have to do the allocation. So try to familiarize yourself with this table, but more than memorizing the table, make sure you are able to understand the table. So the first column, we just say the asset. Okay, so I'm going to go fetch the assets. So I'm going to go fetch the assets. So that's the remaining assets, right? So maybe I'm going to change that wording. So I'm going to change this to remaining assets. Okay, so it is. So now we have carrying amount before impairment. Okay, so carrying amount before impairment. So what is the carrying amount? We go fetch it from our question. So it is that.
Sorry.
Yes.
Does patent fall under the IAS 36 scope?
Yes, because patent is an intangible asset. So an intangible asset is within the scope of IAS 36. Okay.
Okay.
Okay, so there we go. So now we can do the impairment allocation. So remember the following, that when you work out the impairment as we worked out, 2.2 million, you allocate, if the CGU has goodwill, you allocate the impairment to goodwill first as far as possible. So in this case, we could allocate 1,350, okay, 1.35. Now, the remaining asset is 8.858. That 858 must be allocated amongst the assets that fall within the scope of IAS 36. Remember, so there's only those other three assets. We don't include inventory. Now, the question is, how do you do the allocation? The accounting standard says that you allocate the remaining assets on a pro rata basis based on the carrying amounts. Okay, so here are the carrying amounts. So we'll do a pro rata basis. So I do a pro rata basis. We will just work out total over here. And the total is equal to the sum . So the pro rata basis is as follows. We're going to say the remaining impairment. Okay, so the remaining impairment, 858, multiplied by Okay, let me just change that. So we will multiply. It is the carrying amount of the asset divided by the total remaining carrying amounts. The total remaining carrying amounts multiplied by the remaining impairment. Okay, so that's what we will do. So if you follow that process, you will understand that this needs to add up to the remaining amount. I just do a check and I just say that minus that. You don't have to do this in the exam, just for my purposes. Okay. I mean, you can do it if you're using Excel, but it's not a requirement. You're not going to get marks for it. I have time. Okay, so there we go. So now we get the carrying amount after impairment. Okay, so it's going to be that minus that. At this point, does it make sense? Anyone confused at this point?
My is
Yeah.
so the memo that they gave here, they take the patent at 2 million, and then they also the equipment
2 million.
they don't, yeah, the equipment they don't take into consideration the change. They work it out on the old estimate.
Okay, we'll chat on that. Shouldn't be the case.
Okay.
Let me just see. Oh yeah. No, we're getting to that just now. We're getting to that just now.
Okay.
We're getting to that just now. Okay, we're getting to that just now. So are you follow that so far?
Yeah.
Okay.
Yes.
So no question at this point. So I'm doing a systematic method in terms of if you read the accounting standards, because I'm just doing the systematic method. So just it might take a bit longer, but just to get your head around it from a systematic point of view. From there onwards, once you have it, you can figure out your own way that will make more sense for you. But I'm just going on a systematic method. It takes a bit longer, but at least it's systematically following as you read the accounting standard. Okay, so when you read the accounting standard, you understand what they are saying. You will understand that the setup makes sense in terms of how the accounting standard is written. It does not mean this is the only way of doing the calculation. Okay, so now we have the accounting standard says when the carrying amount of a CGU exceeds the recoverable amount of the CGU, you will recognize an impairment loss immediately in profit or loss. You will recognize an impairment loss for the difference. Okay, that impairment loss needs to be allocated among the various assets that fall within the scope of IAS 36. Okay, and the allocation works as follows. You allocate first to goodwill as far as possible. When goodwill is fully written off and there's no longer, and there's still a remaining impairment loss, and there's still an impairment loss remaining, that remaining balance must be allocated to the remaining assets that fall within the scope of IAS 36 on a pro rata basis based on the carrying amounts. Okay, so that's what we did so far. Now the standard says, now, once you've gotten the carrying amount after impairment, compare it to the recoverable amount. Compare it to the recoverable amount. So in most cases, because these assets cannot generate cash flows independently, there won't be a value in use, because if they could generate cash flows if they have a value in use, that implies they can generate cash flows independently. So the fact that they can't generate cash flows independently, it makes sense that they don't have a value in use. So the recoverable amount is only based on the fair value less cost of disposal. So now we have a carrying amount after impairment. But before that's the final answer, we need to do a check. And the check is compare to recoverable amount. Now, they gave a recoverable amount for 2 items. They gave a recoverable amount for 2 items. Where is this now? They gave a recoverable amount for the manufacturing building, and they gave a recoverable amount for the security patent. Okay, so we go plug that in. So 11,1150 recoverable amount 11. What is this now? 150,123. The equipment, there was no recoverable amount given. So all you can do is you make it equal to the carrying amount of the impairment. Okay. And then over here, they gave us 2 million. Okay, so now you need to do the comparison, okay? So now we need to do a comparison. The accounting standard says after the impairment, after you've allocated the impairment to the carrying amount, you must compare the carrying amount of the impairment to the individual assets recoverable amount. The accounting standard says, goes further and say that if the carrying amount is less than the recoverable amount, you need to make a change. Okay, so you will have to make a change in that case. So as you can see over here, that when we do the impairment allocation, our carrying amount is below the recoverable amount. So the accounting standard says you can't do that. You need to make an adjustment. Your carrying amount after the impairment allocation for the individual asset should not be less than the recoverable amount. So as you can see, this carrying amount for the manufacturing building is less than the recoverable amount. So we need to do an allocation, a reallocation. So basically we have a column called reallocation. So the way you just do it, you just say recoverable amount minus the carrying amount of the impairment. That will tell you what needs to be reallocated. So this needs to add up to 0. This needs to add up to 0. Does it add up to 0? The answer is no, it does not add up to 0. So what the accounting standard says, any reallocation that is remaining. So here you can see that 29,000 is remaining. It must be allocated to any other asset that have no reallocation. So which one does not have a reallocation? It is the equipment. So all I will do is I'll allocate it to the equipment. So basically minus 29,348. So as you can see, my reallocation is 0. Now I can get the final impairment. Now I can get my final impairment. My final impairment is the initial impairment allocation minus the reallocation. So if I just say initial impairment allocation minus the reallocation, that is going to be my impairment. So if I add up, ultimately I'll come back to the 858, but it is in a different split. So this is basically going to be my final answer. Now remember, the question asked us to do journal entries. I think I just want to go check the required again. I think it asked us to do journal entries. So I'll go check quickly. So it said this, please prepare the journal entries for 20 accounting. Oh yeah, okay, cool. So they asked us for journal entries. So basically the answer is as follows.
Faiz, just a quick question. Sorry, man.
Yeah.
You said we only do the reallocation if the carrying amount of the impairment is more than the recoverable amount for the individual asset. So do we still do the reallocation for the patent?
Yes, because the carrying, because remember the individual asset. So let me just change this quickly. The individual asset also can't be above its recoverable amount.
Okay.
So now we can do the journal entry, and this is what the actual answer is. Okay, so the actual answer is 28 Feb 2019. 28 Feb 2019. We're going to have debit, credit. All you can do, you can have one line item says impairment loss, P&L. So the accounting standard, so I-36 says an impairment loss is recognized immediately in profit or loss unless what? If an asset is measured using the revaluation model, then you must first reduce the revaluation of the asset, and then the remaining goes through through profit or loss. Over here, we had no revaluation models. I don't think we had any revaluation model. I'm gonna just check again. I think the security, I don't think we had any revaluation model. I'll just check now again. And then you recognize the full amount through impairment. Okay, so basically the impairment loss, I'll just check again if everything was cost model. So impairment loss would be 2208, and the remaining would be, you can't say you need to go through each asset now, so you're gonna have to say accumulated impairment or accumulated depreciation, whichever you want to call it, accumulated impairment. I'm not gonna write full things, manufacturing building. You have to write full manufacturing building, accumulated impairment, equipment. Okay, so I'm gonna say equipment. The one above would be accumulated impairment, goodwill. Okay, the last one, accumulated impairment, security camera patent, what it was called. What was it called? Security camera patent. You must write full words. Now I just go fetch it. It's going to be 1350. It's going to be final impairment. There we go. This is going to be SFP. So it's going to be some. I just want to check before I finalize the journal entry. So far it's finalized, but I think I just realized something. 22 minus 208. Okay, so there we know the journal entry balance, but I just want to go check something. So remember, the standard says, what does the standard say now? That an impairment loss is recognized immediately in profit or loss. So the general rule is impairment loss is recognized in profit or loss. But they say, however, if there is an asset included, if there's an asset that is that carrying amount is based on the revaluation model, then you must first reduce any revaluation amount through OCI, and the remaining amount must go through the impairment loss. So for example, over here, we want to put through 500,000 to the security patent. I think the security patent is using the revaluation model. So we'll just have to go check that quickly. I just quickly want to go check it. Can't remember what I read. Yeah, so you see the intangible asset is accounted for according to the revaluation model. Okay, so just take note over here quickly. So I just want to change something over here. I just want to change something over here that is important to take note. So with the security camera, we just need to fix on something quickly. The security camera happened as follows. On security. So the security camera patent was acquired on 1 March 2019 for 2 million. Okay, it has a indefinite useful life, so there won't be any amortization. It has an indefinite useful life, so it has no amortization. Amortization is the terminology used for an intangible asset, where in PPE we call it depreciation. So amortization is an intangible asset's depreciation. Okay, so because of the indefinite useful life, there is no amortization. But they told us that on 28 February 2019, the carrying amount is 2,500. Okay, so that means the only way that thing could have increased, there was no additional purchases. So the only way that could have increased is through a revaluation, and it makes sense because they told us that the measurement model for the security patent is the revaluation model. So the increase can only be as a result of impairment. I mean, as a result of what now? Tell me. Revaluation. Okay, so if I do that, the increase can only be as a result of a revaluation. So as you can see, the impairment relating to the security camera is 500,000, and the revaluation is 500,000. The accounting standard says an impairment loss is recognized immediately through profit or loss, unless what? Unless you have an asset that is revalued, and so before you take the impairment loss relating to that asset through P&L, first decrease any prior revaluation. Now we know what was any prior revaluation amounts to 500,000. So what we will have to do over here is first recognize a decrease in revaluation. So we can say revaluation decrease, revaluation loss. For PPE asset, for intangible asset, for PPE, a revaluation goes through OCI. So what would happen actually, this must be 500,000. That is the revaluation. And this would equal 2208 minus whatever goes through the revaluation. So just take note of that. Okay, so just take note of that. So that's an important aspect. Okay, so the rule is that an impairment loss is recognized immediately through profit or loss, unless there's an asset that is revalued. So before you take that asset's impairment through to an impairment loss in profit or loss, you must first reduce any prior revaluation, and that reduction in the revaluation must follow it wherever it goes. Because prior revaluation goes through OCI, the reduction in the revaluation also goes through OCI. So as you can see, the full revaluation, the full impairment loss relating to the security camera goes against revaluation. Okay, so over here, for the security patent, there's no accumulated impairment. A revaluation just goes directly against the actual item, security camera patent. So depreciation and impairment goes against accumulated depreciation, accumulated impairment, but a revaluation goes directly against the cost of the asset. So as you can see, any impairment is going against accumulated impairment, whereas the revaluation loss is going against the cost of the item, which is called security camera patent. Okay, so that is it from my side. Do we have any questions? So you guys can see how you want to set this out. You can see how you want to set this out, but basically if you follow the accounting standard, it says carrying amount before impairment. Okay, so we have carrying amount before impairment for the remaining assets. Impairment allocation, so you pro rata the remaining impairment loss based on the carrying amounts of the remaining assets. So that gives you a carrying amount of the impairment. Once you have a carrying amount of the impairment, compare it to the recoverable amount. The recoverable amount in most cases will only be the fair value less cost of disposal. You won't have value in use, because if you had value in use, it means that that asset can generate cash flows independently. So now you do comparison, and then you get the reallocation. Okay, so remember, this reallocation needs to actually, in most cases, has to be zero. Needs to be zero. It won't always be zero. It won't always be zero. Because if everyone had a recoverable amount, then it won't necessarily be to zero. But like we said, equipment didn't have a recoverable amount, so we made the recoverable amount equal to the carrying amount of the impairment. So the accounting standard said if you have an asset of that nature, then the remaining balance just goes against those assets on a pro rata basis. There was no need to pro rata the 29 because there was only one asset that we could allocate it to. But if there was two assets, then you'd have to do a pro rata basis for that remaining amount. So the final impairment comes initial impairment minus the reallocation, and that gives you the final impairment. And then you can just check for your own purposes. You can just check for your own purposes, not required, carrying amount after final impairment. It should be what you want. It should be the recoverable amount. Okay. So this is not required. Just to do a check for yourself. You take carrying amount before impairment minus final impairment. And there you can go. It gets you to the recoverable amount that you wanted. So that shows that, well, it appears to be correct. Okay, so there we go. That is the journal entries. Do we have any questions on your side? Let's just have a look or send a message. Okay, so the final impairment is just basically the initial impairment minus the reallocation. Okay, because ultimately this is the initial impairment is correct, but when we compare carrying amount with recoverable amount, we see there's a problem. So you need to do a reallocation. Maybe we call this a reallocation of impairment. So the reallocation, so your final impairment is basically impairment allocation or initial impairment allocation minus the reallocation. Okay, does that answer your question, Ashita? Okay, so let's have a look. Ashita, any other thing confusing on your side? Bernice, Fakir, anything confusing on your side?
Oh, no, no questions.
Bernice? Melissa, Rebecca, anything confusing your side? Any questions your side?
No.
Rebecca, Rodney, any questions? Anything confusing your side? Okay, all good. Felice, Tandy,
No questions.
anything confusing still? Nothing at the moment.
Nothing at the moment.
Tandy, Sibinzile, Ryan,
No questions.
okay, so there's nothing else. So I'm going to stop the lesson over here. When it is done recording, I will send you the recordings and the Excel or the Google Doc is in the Google folder. Okay, so all of you should have gotten an email to say you have access to a Google Drive. So you will find this in over here, so you can have a look at it. Like I said, on Thursday, we're doing an additional class for, so on Thursday, we'll do additional class when it comes to this impairment, because this is one aspect of an impairment. We're going to cover a question where they bring in another aspect. So far what we have covered is impairment. So we've always done individual assets. Before CTA, we've always done an impairment on an individual asset. I-36 wants you to do impairment on an individual asset. However, it says if the individual asset cannot generate cash flows independently, then you will have to include that asset in a cash generating unit. A cash generating unit is the smallest group of assets that can generate cash flows independently that asset belongs to. Okay, so like in this case, none of these assets could generate cash flows independently, so therefore we needed to do an impairment test using a cash generating unit. So then we get the impairment and we allocate the impairment loss amongst the individual assets. So we have covered with goodwill, so just the important aspect of goodwill, when a cash generating unit includes goodwill, two important things: the cash generating unit must be tested for impairment annually, and then any impairment loss is first allocated to goodwill as far as possible. Any remaining impairment loss is allocated to the remaining assets on a pro rata basis based on their carrying amounts. Okay, so just take note of that. Then for an intangible asset, if an intangible asset has an indefinite useful life, then you will also have to test for impairment annually for that intangible asset. If that intangible asset is an individual asset, you test for it independently, you test for it on its own annually. But in this case, the intangible asset cannot generate cash flows independently. So therefore, it formed part of the cash generating unit. Therefore, it formed part of a cash generating unit, right? So therefore, it formed part of a cash generating unit. You guys, okay, so therefore, it formed part of a cash generating unit. And as a result, we had to test for the cash generating unit for impairment annually. In this scenario, the cash generating unit also had an indication of impairment, but that was not a requirement. Okay, so just take note of that. Now, in one of the other questions we're going to cover is the issue relating to corporate assets. The definition of a corporate asset: an asset is a corporate asset. Any asset can be a corporate asset. It just depends on the structure of the business. So a corporate asset must meet two criteria or two characteristics. Number one, it does not generate cash flows independently. And number two, it cannot be allocated on a reasonable and consistent basis to a particular cash generating unit, or it cannot be allocated on a reasonable or consistent basis to the cash generating unit that we are looking at, okay, that is under review. So for example, you'll have a situation where you have a company that has two divisions, Division 1 and Division 2. Okay, so there are two manufacturing divisions, whatever they manufacture. Now, in order for them to manufacture, they need a factory. Now, the factory houses both. The factory houses both. Divisions. So the question would be, is the factory a corporate asset or not? So that is the question we're going to answer. And then if it is a corporate asset, how do you deal with it? If it's not a corporate asset, how do you deal with it? Okay, and then if it is a corporate asset, then there's two possible ways of dealing with it. So that is why I want to cover it with you. CTA 2, they're probably going to throw that at you. Okay, so we're going to, I'm going to make sure the questions are selected. It came through in CTA 1, because I remember covering this extensively for CTA 1 student. So it will be, so we'll cover it. So that is the additional class. We're going to cover one aspect of it, and then I may have a second additional class to cover the other aspect of it. Okay, so Thursday is not our normal class, but it's just to make sure that we give you guys the best opportunity to handle any impairment question that may come your way. Okay, so I'm going to end the class over here. I'll see you guys tomorrow for Fact 2, Fact 4. We will continue with changing ownerships. If there's no other questions, you guys are good to go. I'm going to end the lesson in the next 10 seconds if there's no questions from your side. Okay, bye-bye.